Welcome to The Explainer. I am so pumped you're here today. We're going to completely demystify the complex mechanics of an economic downturn. And we're doing it by diving straight into the actual, direct source data. No fluff, just the facts. We're going to really grasp what happens when the economy shifts gears.
Here's our roadmap for today. 1. Defining the R word. 2. The toll on jobs. 3. Decoding the yield curve. 4. The ultimate warning sign. And 5. Winners and losers. Let's get right into it. Section 1. Defining the R word. To start our detective story, we first need to clearly define the crime itself. What exactly constitutes an economic downturn? You hear the word recession thrown around constantly in the news, right? But the actual definition is a bit more nuanced. The official National Bureau of Economic Research, or NBER, doesn't just look for a quick little dip. They define a recession using what we call the 3 Ds: duration, depth, and diffusion, meaning it can't just be a localized blip. It literally has to be a significant decline that spreads across wide portions of the economy and sticks around for more than a few months. It's a very broad, holistic measurement. Now, let's contrast that with a depression. In a depression, those 3 Ds are severely amplified. It's much more severe, lasts significantly longer, and leaves a far deeper, more permanent scar on business investments and employment. Think of it like this. A recession is a bad economic cold, but a depression, that's full-blown pneumonia for the economy. And that broad NBER definition runs right into a major ongoing debate in economics. Contrast that holistic view with the much more traditional Shiskin rule, named after Julius Shiskin back in 1974. He simply looked for 2 back-to-back quarters of shrinking real GDP. It's a much simpler mathematical rule of thumb. But here is the catch. Relying solely on 2 negative GDP quarters can be deeply flawed. Why? Because economists often need a giant eraser for their erratic data revisions. Take the US in 2001, for example. The initial data showed alternating positive and negative quarters, so technically that didn't trigger the 2-quarter rule. But later on, the revised data showed it absolutely was a recession. So revisions can easily flip the script on whether we're officially in a downturn or not. Section 2, the toll on jobs. Numbers on a spreadsheet are one thing, but employment is where downturns really hit home. Looking at historical peaks, the U.S. labor market operates in distinct, sometimes brutal cycles. We've seen massive job losses strike during the Great Depression in the 30s, the energy crisis in the early 80s, the Great Recession peaking around 2010, and, of course, the incredibly short shock of the COVID-19 pandemic. Just take a moment and think about this number, 24.9%. That staggering figure is the peak unemployment rate from 1933, right in the thick of the Great Depression. It remains the absolute highest in U.S. history. Entire industries just collapsed, and many people remain jobless for well over a year. It completely reshaped an entire generation. Fast forward to April 2020, and we see a sudden 14.7% spike. That represented 20.5 million jobless Americans in the wake of the pandemic shutdowns. Now, while it's lower than the Great Depression, this was actually the largest one-month unemployment increase in recorded history. It was an absolute freefall for the labor market. But recessions, they don't impact everyone equally. Breaking down the demographics from May 2020 reveals a pretty stark reality. Minority workers and women bore a disproportionately massive burden. For context, while white men faced a 9.7% unemployment rate, Hispanic women faced a staggering 19.5% rate. The economic pain is highly, highly concentrated. Section 3, decoding the yield curve. Now that we've seen the damage recessions cause, let's pivot to the clues. We're going to decode what's widely considered the ultimate economic crystal ball. Normally, financial gravity works a certain way, right? If you lock your money away for 10 years, you expect a higher return than if you just lock it away for 1 month. But look at the upside-down reality from March 2024. A short-term 1-month commitment was somehow paying a massive 5.50% yield, while locking it up for a full decade paid only 4.11%. The natural order is completely flipped on its head. So why does this inversion actually happen? Well, when investors demand higher payouts for short-term bonds, it's a massive red flag. It tells us they are extremely worried about the near-term future of the economy. They're essentially demanding a premium just to take on short-term risk, all because their long-term expectations have fundamentally soured. Section 4. The ultimate warning sign. We know what an inversion is, but let's look at the historical proof to see just how accurate this warning sign really is. Tracking the spread between the 10-year and 2-year Treasury yields is absolutely fascinating. Every single one of the 6 major recessions since 1976 was preceded by this spread turning negative, or inverting. And the recession usually strikes anywhere from a few months, like 159 days back in 2019, to just under 2 years after that initial inversion. It is an incredibly consistent leading indicator. But here is the dramatic twist in our detective story. The recession usually doesn't hit while the curve is actively inverted. Nope, the actual economic contraction tends to strike right after the curve starts to normalize or uninvert. And why is that? Because that uninversion is usually triggered by the central bank slashing interest rates in a total panic as the economy finally begins to break.
Section 5. Winners and losers. When the yield curve flips and the economy teeters, who exactly wins and loses in this bizarre environment?
First up, the losers. Everyday consumers who just want short-term loans, they get punished with much higher interest rates. Banks get squeezed really hard too, since they borrow short-term and lend long-term, an inverted curve severely compresses their profit margins. And on top of that, high-yield dividend stocks usually take a beating because investors flee those stocks for the sudden, safe, high yields offered by short-term government treasuries.
Conversely, look at the winners. Corporate giants sitting on massive piles of cash, think Apple or Berkshire Hathaway. They suddenly rake in absolutely huge returns on their short-term cash reserves, all without having to lock that money away for years. It's also a fantastic environment for investors who are willing to accept the implied short-term risk just to lock in those juicy, elevated short-term yields. Ultimately, while the bond market does all the complex predicting behind the scenes, the real-world trigger is usually this toxic collision. Rising consumer prices violently clashing with plunging consumer sentiment. That's what forces everyday people to close their wallets. And when the consumer finally stops spending, well, that's what forces the broader economy to actually contract. I want to leave you with this final provocative thought. Given that our current yield curve has been inverted for an unusually long time since 2022 without an officially declared recession, we really have to ask, is the ultimate economic crystal ball finally broken, or are we just trapped in the world's longest waiting room before the inevitable drop? Thank you so much for joining me for this explainer. Keep looking at the data and stay curious.